Hey everybody, welcome back to the channel. I'm Doug, the retirement guy with all your monthly ETFs. And today we're breaking down NEOS. We're going to put NEOS against NEOS. And this actually came from one of our viewers' comments that they left into it. And I thought it was a great comment, and I thought it was a great piece to go to kind of give you a comparison between two identical NEOS funds and how would you use them in a retirement account. And those two funds that we're talking about is going to be the NEOS QQQI and the NEOS XQQI. One is standard income, one's going to be boosted income. I always say it's like having a big cup of coffee to boost your way going forward in the day. So let's get into today's video. And before we do, I got to do a shout out to all of our new subscribers. Welcome aboard. Hope you enjoy the shows. We try to do this on a regular basis. As long time flies, I am a retiree. I have been retired for well over 10 years, living off my own distributions. So sometimes I do take some breaks and I do take some fun time, but we always try to get you as much information as we possibly can. Also, got to give a thanks out to all of our Patreon supporters and everyone that's added in. Patreon is a wonderful way you can support the channel, but you can also join for free and just get additional information. So don't be afraid. Look down at the description below. Click that link and join. We'd love to have you. Let's get into today's video, NEOS versus NEOS. We do have to do the disclaimer, and that is past performances don't guarantee your future results, and this information in this video is for educational and informational purposes only. I am not a licensed financial advisor. I am just one who's been studying this stuff for years. The example and suggestions discussed here are basically not suitable for all individual situations, so always contact a financial advisor before making financial decisions. So the income generation mechanics, the NEOS high yield analysis, it's a shared strategy foundation. They use a physical equity. They hold top NASDAQ 100 stocks like Apple, Nvidia, Microsoft to collect core dividends. Now, they write out of the money calls, OTMs, those options to generate higher premium income monthly. And they do that on the NDX index options. So they're not really selling their stocks. They're working off of out of the money calls with the index. So the upside potential is the OTM strategy allows for the capital appreciation before the stock price is reached. So the difference between the two funds, NEOS QQQI, what I call the standard version, is 100% we call normal exposure. It's a direct one-to-one exposure to the core NASDAQ 100 income strategy. It generates high yields without using any financial leverage. Standard risk profile tracking the NASDAQ 100 index performance. Now the NEOS XQQI, which is we call boosted, is 150% exposure. So it uses options and leverage to amplify the core strategy by 1.5 times. It amplifies both the option premium income and the equity price action. Now this is an aggressive profile. QQQI it's like QQI on financial steroids for maximum yield. Okay? Very critical two pieces. And I want to be right up front. I'm going to give you the first alert and first warning of everything. When you use leverage is like a double-edged sword. Okay? Good times, you're going up 1.5 times. Bad times, you're going down 1.5 times more than the fund will do. So it's like the roller coaster ride. And I've talked about this in different videos. When you talk leverage, you have the roller coaster. When you're going up 1.5 times faster. When you're going down 1.5 times faster. So you really got to dial yourself into of do you need this risk? Do you want that risk? And that's your first warning across the board. Do you need it? And do you want it? Let's talk about expenses. Now, expense fees All the numbers I tell you after this point will include these expense ratios. They'll exclude these fees added into it. So it's not take this and then deduct it. But everyone wants to look at this. So when you take a look at NEO's QQQI, has a 0.68% expense ratio. Very, very basically call it middle of the game, middle of the park. The management fee, 0.55. Other expenses, 0.13 to get you that 6.68. So it's lower your costs, more money stays invested at 0.68. Now, there's other funds that are higher, some other funds that are lower, but it's really right down the middle of the park. Now, their XQQI, their expense ratio actually goes to 0.95. Management fees are 0.80, additional fees 0.15. The higher cost, the price of boosting exposure and income has a cost. There's more work to be done. That's why you see a higher expense ratio. Both funds have reasonable fees for their strategies. XQQI's higher fee reflects the added complexity of the leverage exposure that needs to happen. So again, I'm being very fair across the board with these. So if you have to pay more in fees, you better get more for your money as we move forward. So let's take a look at yields. Now, I will tell you up front, yields, I do not, what we call yield chase. We don't go after just yields win the game. If it was, this would be a 5-minute video. You're done, going home, and history. Well, there's more behind the curtain than just the yield number, and we're going to teach you that. So the NEO's QQQI comes in about 14.11%. The NEO's QXII is 10.10%. So about a 6% difference between the two. So you can see already that leverage help, that leverage difference makes a big difference in yields. But is it big enough to say yes or no? So how does QQI generate its income? Well, QQQI primarily relies on covered call option strategies combined with direct equity ownership to generate a target distribution yield of around 12 to 14%. Now that comes directly from NEOS. So how did they do this? Well, first off, number one is the equity core. QQQI buys and holds actual stocks that make up the NASDAQ 100 index. Companies like NVIDIA, Microsoft, Apple, Amazon. It means it collects whatever base dividends these companies pay out. Now, I know it's very low. Historically, it's about 0.4%. But they do this for a particular reason. This is where they're getting a lot of growth from. If the funds will go up, their core equity is what grows accordingly. Now, the second tier is the call option overlay. The income engine is what I call it. The fund managers sell right call options against the NASDAQ 100 index, NDX. So when you sell a call option, the buyer pays you upfront fees called an option premium. So the premium primarily supplies the bulk of QQI's large monthly distributions. Now, something they also do, instead of just selling basic covered calls, which completely caps the upside growth, QQQI often utilizes a call spread strategy. They sell out of the money calls to collect the premium, but they also buy further out of the money calls. Excuse me. They do some creative things in generating as much potential income as they can, all based off of the NASDAQ 100 index. So how does XQQI differ? Well, this one basically does the boosted version. QQI takes the same exact concept that QQQI does, but layers it with a leverage to enhance both the income potential and the equity appreciation. Now, it aims at roughly 150% of the normal portfolio exposure, and they're trying to get an 18 to 22% targeted yield. So number one is the same. They buy the same exact funds, they build it the exact same way. But number two is that option overlay with that synthetic leverage. So to boost the exposure without physically borrowing massive amounts of cash, XQQI buys index call options and sells index put options at a similar strike price. This creates a synthetic long exposure leverage. So they're buying and selling options on both sides of the fence. So the income component, XQQI, then layers data-driven NDX covered call strategy over the amplified base. Because the underlying exposure is structurally larger, the fund has a larger base than which to write call options on. That's the huge factor of all this. So the higher net distributions, greater participation in rising markets, and increased premiums, income potential. Now, because it utilizes leverage, it also experiences that modified or magnified losses if the tech market takes sharp downturns. Now let's talk about growth. Well, when we take a look at the NEOS, QQQI comes in at 4.44% year to date, while the NEOS XQQI is only up 2.63. Because of a week ago Friday, we had that massive sell-off, right? And then we kicked in again, I believe, on Monday or Tuesday, had another big sell-off. So what happens is this is the leverage. And I'm going to show you here shortly is the leverage that happens is cut your growth literally in half. So you're playing with, I call it fire, but you're playing with a different mix. You're playing with a different game. You're playing with a whole different strategy when you're using the boosted side. It's great in good times. It's horrible in bad times. So let's take a look at the two funds. Okay, I'm going to start off with virtually. They are only 2 years apart. I was shocked at this one. We're going to start with QQI facts. $11.99 billion on their net assets. Expense ratio we talked about 0.68. 221 million shares outstanding. It paid a distribution of 7.60 for a total distribution yield over the past 12 months of 13.51% at the day of taking the snapshot. It's been bouncing with that $55 to $56 price range with a $57 high. Now this came out January 30th of 2024. So you can see 4.38% growth. When we look at the assets, $212 million, so considerably less than XQQI. Expense ratio higher, 0.98, only 4.28 million shares outstanding. It paid a $4.21 dividend and an 8.17% yield. So dramatically lower. Okay, but you got to remember, we're not in the full year yet. These are snapshots. This is giving you a snapshot of, basically 6 months compared to 12 months above. And now this fund runs between a $50 to $51 price point at a high of 54. Okay, so we are not this is really not giving you apple to apple comparisons, but in the factual side, what I did here is I did it to year to date. So January to today. And you see 4.38% growth versus 2.63. And it's at the end. Remember this W, that's at the end. Okay? To where it took a huge drop off, came back a little bit, took another huge drop off, and now it's starting to recover out of the W. That's leverage, guys. That's the leverage difference to show you the difference between the two is virtually 2% difference. When you look at the patterns are identical to each other because they're both identical. They're brothers and sisters acting exactly the same other than with a boosted mark. Tax harvesting. Now, the tax efficiency of these funds, both of them use Section 1256 contracts, which give you that 60-40 rule. 60% long-term, 40% short-term gains, the treatment of all option gains. Significant lower tax liability compared to 100% ordinary income generating by standard ETFs, and utilizes the industrial grade NDX cash settled index options for maximum efficiency. Now, the active tax loss harvesting, they use ROC, return of capital. So systematically sells losing equity positions at the manager's level to offset distributions. It presents a heavy portion of the monthly payouts as return of capital, which kicks your tax burden into future years. Now, it allows for the tax deferred income by lowering the investor's cost basis over time. I give you, Neos has really been one of the top people out there that do a great job with the tax side of it. Compared to QYLD or IYLD, they just have the superior advantage. But now we talk total returns. And this is a number I talk a lot about because this tells you a lot about a particular fund. Now we looked at yields. Yields went XQQI's way. Growth went QQQI's way. So here we are at total returns. Year to date, QQQI is up 10.75%. XQQQI is up 14%. It's a big difference between those two. So does that make XQQI better because of total return? Well, in some cases, yes. But you got to remember that double-edged sword. So I'm going to explain both of these in the same factor. The bull market performance. XQQ boost that captured that 150% growth, while QQI uses that standard growth. The income leverage that QQI gives you that 19 to 23% because of that higher growth and that higher 1.5 times the upside. Now, in bear markets, the amplified downside, just as I explained, XQQI faces that 1.5 sharper declines, capital erosion. QQQI is more stability, maintains that 1-to-1 exposure. When we look at the total returns, now I go back. Look at the X is in the brown and Q is in the blue. All the way up to about April 20th. And maybe we're backing up, maybe April 15th. QQQI has been ahead in total returns. And you can see the drop off, and I'm going to give you right in the middle of the screen, you'll see the drop off and a big gap between the two funds. That's the leverage. That's the negative leverage in a bear market. That's a leverage that drops off. And now the X is dramatically increased to catch up. And when we come in around April 15th, they crossed the lines and then it never covered back. It's been above 4%. So is XQQQ better? Well, if you can stand these drop-offs in the bottom, if you can stand the wild rides that it will give you, yeah, you can definitely enjoy a higher level of income. I always say this, you got to choose the right fund. Neos QQQI is a very conservative, moderate income unit. It's stable. It's tax efficient. It's a tech income without leverage. It avoids amplified volatility and capital erosion risk. It captures the full NASDAQ 100 equity upside, 1.1 exposure, and has that lower expense ratio. The investor verdict, I would choose QQQI if you want steady monthly income without adding leverage and volatility to your portfolio. What does that sound like? That sounds like retirees. Retirees want to have that steady income, that steady flow across the board. The Neos XQQI is for the people who want to gamble a little more. They want that aggressive maximization of that monthly cash flow, that 19 to 23%. They want big income. And remember, every time I tell you go over 15%, there's going to be some negative pieces to it. The 1.5 boosted exposure is great on the positive days. It's horrible on the down days. It outperforms sustained bull markets with that leverage. But choose XQQI for seeking maximum yield and believe in the Nasdaq's long-term growth, accepting those wider swings. So where do I personally put this? And I said, if you are into retirement, if you're sitting in there, why swing for the fences trying to get that extra, that extra 5 to, I'll say 7 to 5 to 7% more? Okay. Is it really worth trying to get that extra point with XQQI because of the leverage that happens? While most people are comfortable with that high 14% from Neo's QQQI, I think it fits perfectly, and I think I worded it properly, is that wants that steady monthly cash flow without the leveraged volatility. If you're comfortable with having a little more risk, a little more upside, downside, you like the big days and the bad days, then XQQQ can work in a retirement thing. But I personally still think QQI is the best. So I would love to know where you sit. Is which one of these funds do you actually think? Are you in a point that you're willing to gamble that 1.5 is not going to bother you to get that extra gain? Or are you willing to just ride the road with the common denominator? Let me know in the comments below. Also hit that like button. We appreciate everything that you do.
Thank you for watching. Press the